Hi, this is Anita from Real Estate Crunch. Today we're going to talk about the pros and cons of the fixed or variable rates of mortgages and which one you should consider. It can be very confusing if you're looking to buy a property. Do you want to have a fixed rate or do you want to have a variable rate? And hopefully we'll be able to answer some of those questions for you. First of all, let's talk about the fixed rate. What is a fixed rate? A fixed mortgage rate has an interest rate which remains constant for the entire term of the loan. In other words, you get a loan, the rate's going to remain the same. There's no second guessing. You'll always know what the rate will be. It means that your monthly principal and interest payments stay the same, providing consistency and stability and predictability. So you never have to second guess. The pros of a fixed mortgages are it's stable and predictable. So there's no second guessing at all. It can protect against rising interest rates. In other words, if you are a lucky person, you get a mortgage on a very low interest rate, and the rates rise, then your rate will not rise. You'll have still the lower rate. It'll be easier financial planning. You'll be able to plan your finances. You'll always know what your cost would be, and it can give you a sense of a peace of mind. Some of the cons of it is if you have a higher initial interest fixed mortgage rate and suddenly the rates go down, then you're going to end up paying more. There could be less flexibility. Once locked into the fixed mortgage rate, you're unable to benefit from potential decreases if they happen. And there could be a higher total interest cost. So basically, when should you choose a fixed mortgage rate? Well, of course, if the interest is very low and it's for some reason extremely low, you might want to consider doing it then. It could be for those who just simply value stability and predictability. They plan to stay in their homes for a long term. So it's going to be a long-term investment. You want to have the predictability. You want to stay there. With people have a lower tolerance for financial risk. And those in rising interesting rates environments want to be able to lock in a favorable rate. So like the fixed rate, this would be a rate that would always be fixed throughout the term of the loan. The other type is the variable rate mortgages. So a variable rate mortgage, also known as an adjustable rate mortgage, has an interest rate that fluctuates over time on changes in the market. These mortgages often start with a lower initial rate that adjusts periodically after a fixed introductory period. So some of the pros of it is that you can lower initial payments. You may end up with lower initial payments if you start at the lower end of the interest of it. The potential for payment decreases, that as the interest rate goes down, you could also end up having your monthly payments go down. Flexibility, if they plan to sell or refinance the home before the variable rate adjusts, this option could be good for short-term savings and lower long-term costs in a stable market. Now, here's the clue here. In a stable market. If it's not a stable market, it may not be lower long-term costs, and in fact, quite the opposite. So some of the cons of it, as you can imagine, on the other side of this is really about uncertainty and risk, that there will be risk involved. If suddenly, when you first got your mortgage, let's say if the mortgage rate was, very low, and suddenly now it's gone up or it's doubled or tripled, you'll end up paying that much more. So there is a risk to this. It can be harder to budget. It can be harder for you to know exactly, what to budget or what you need to budget because it can be changing and fluctuating. It can be a potential for payment shock. In other words, you may first get like this great introductory offer and it remains, really well, then all of a sudden, poof, it goes way up. And it can be complex. There can be complexity involved with this with the constantly changing rates. So who are somebody that might want to consider doing a variable rate mortgage? Buyers uncomfortable with risk and market fluctuation. Individuals planning to sell or refinance their home before rate adjustments occur. And those expecting interest rates to remain stable or decrease over time. In other words, if you buy a house and the interest rate is high, you may not want to have a fixed interest rate for that. You might want to consider a variable one and hoping that the rates will go down. But of course, it's a gamble. It's not guaranteed. And you just really don't know if that's going to happen at all. So, a lot of this depends upon how much risk tolerance you have. are you able to handle the risk tolerance? Also too, the economic factors. What's the economy looking like for the day? How long is your loan? Did you put a huge down payment on the property, and you don't really have that long term of a loan? Then that might be one way of deciding this. What are your budget and financial goals? And are there any rate caps or terms that you need to be worried about? So, we've written a blog post on this titled "The Pros and Cons of Fixed versus Variable Rates." So if you're interested to see what the best one would be for you, or the best one for you to consider, you can check out the blog post. We'll put a description in the link below so that you can be able to check it out to be able to see. Of course, at the end of the day, it really comes for you to decide what you think is best for you, for your budget, for your family, and what you think would be the wisest choice for you to make when it comes to your money. This is Anita from Real Estate Crunch. Thank you so much for listening. We sure do appreciate you, our listeners. And do check out our blog and check out the link in the description. Thank you so much.